The Canadian government has big ambitions to make this country a global energy superpower. It was one of the key themes highlighted in a meeting this week between Prime Minister Mark Carney and the country's premiers. But what's it actually going to take to get us to that point? And does this initiative create potential investment opportunities? Joining us to break it all down is Hussein Allidina. He is Managing Director and Head of Commodities at TD Asset Management. How are you?
I'm great, excited.
Two parts I want to talk about, I think more is Canada and the global energy superpower, and then just the idea of how much energy is going to be needed as we move ahead. So these are the my two questions over the next little while. At a high level, what does it mean for Canada to become, assuming it's not, a global energy superpower? What does it take? What's in the way?
So we're the fourth largest crude producer globally, so I'd say we are a superpower. But I think that we've likely been punching below our weight, right? We've been blessed, not just in energy, but from a commodity perspective. We've been endowed with a tremendous amount of resource. And I think we've neglected the development of that resource for different reasons over the course of the last decade. I think Prime Minister Carney's refreshing take on it is welcome. We're going to need, I think we're going to need the energy, we're going to need the commodities. So I think there will be a market for it. But it does take time, and we've talked about this before, like the reason a commodity cycle exists is because it takes time for supply to respond. So even with the best of intentions, which I think the Prime Minister has and the Energy Minister now has, it takes time to build out.
Can we just elaborate on that a little bit? Because I think it's interesting for people to know, because we hear, I know TD Economics came out, this wasn't pipelines, but they said I think it was 18 years to bring a mine online in Canada. But when you were chatting earlier, saying even if we had all the approvals, everything we needed to get done and just started, takes 2 to 3 years to build a pipeline.
So let's just take an example of TMX, which came on last year. That project took 11 years from sort of idea to the first sort of commercial use. Northern Gateway took 14 years, 12 years before it was canceled. Right? So there is a process that we have to move through, and I imagine that the federal and provincial government, if there is appetite, can expedite that, but there are physical challenges, physical constraints associated with laying pipe or building upstream, downstream production, and that stuff takes time. 2 to 3 years is probably very optimistic. 11 years might be on the long end of things, but can we get pipelines and infrastructure built in 5 to 7 years? I think so, if there is appetite to do that.
How does that, as someone who watches commodity prices, how does that affect how you look at things? I mean, you know, it's material. I assume at some level later on. But how are you thinking about it?
So I'm excited about it as a Canadian, because I think it's phenomenal for Canada's potential GDP, what it means for the dollar, what it means for GDP per capita. It doesn't make me any less bearish commodities near term, because it takes so long to bring this production to market if things go well. Generally speaking, I'd say, and I'm sure we'll talk about the oil market later, but like the focus of market participants, broadly speaking, is the next 6 to 12 months, maybe 18 months. Are there folks trading, oil 5 years forward? Yes, but not meaningfully. And again, I think even 5 years forward is probably the earliest where we see kind of the supply-demand impact of policy changes which are happening today.
Is it, and so when you are building pipelines and making the plans in terms of, what the paybacks are and revenues, you have to look at oil prices 5 years out, not 6 months out, to your point, and you see transitions happening with, LNG, nuclear. I think Meta just signed a deal with a 20-year deal. So how do you, what do you longer term see for the demand for oil?
So I think there's two things there. So on the long term, the demand for oil is going to be highly, highly correlated and a function of GDP growth first and foremost, and then your alternatives. Today, whether we like it or not, oil is still one of the cheapest forms of energy. It's the most available, it's secure, it's easy to move. And I don't see demand, we've talked about this for years, I don't see demand for oil peaking the way that some have argued will happen before 2030. I think oil demand continues to grow if the economy continues to move. On the price level that is discounted when you're thinking about the DCF of a company or the economics of a pipeline, oftentimes the forward curve will be used. So we'll look at the forward curve and use that as kind of the expected price. But the forward curve is not a predictor of future price. So we use it, or analysts will use it, but ultimately if you take the forward curve, or if you look at the forward curve, you have this sort of misguided idea that oil prices are decreasing in the future. The weakness in forward prices will discourage investment, all else equal, which makes it all the harder.
And what about if I just say power? If I kind of bring, oil is one way of powering the economy, but the demand for power overall for the next little while is you just see up and to the right is how or is it?
Yeah, no, I think it is. So globally, demand for power will grow with GDP. So as an economy industrializes, their power demand increases.
But AI and...
But if you look in the developed market, so in the U.S., for example, power demand for the better part of 20 years was flat to down because we were exporting our manufacturing, our power demand elsewhere. Today, if we look at power demand in the U.S. over the course of the last 12, 16 months, for the first time, it's been increasing. It's been increasing because, as you said, ChatGPT or AI-related demand, as well as energy transition on the margin, you're seeing substitution out of ICE vehicles into EV vehicles. I think the outlook for power is quite constructive globally and locally because of the growth in the economy together with this, what seems like insatiable demand from AI.
Bring it back to Canada. LNG, of course, is something that that we're focused on here as well too. And I think the first exports from Kitimat are getting closer.
Yeah.
But Canada are we not like a later player on the LNG stage?
Yeah. So globally, like your largest LNG suppliers are the U.S. and Qatar, and it does take time to build liquefaction capacity. And we're definitely behind the ball. But again, if we look at the world and we anticipate that GDP is going to continue to increase, power demand is going to continue to increase. A lot of that power today is met with coal. Part of the reason that power is met with coal is because China, India, et cetera, have coal, and security of supply has become an issue in the last couple of years. I think that Canada should develop and continue to develop their LNG. We should try to do it quicker than we have been doing it.
Yeah.
But ultimately, we're going to need to grow power supply. Nuclear will fill part of that gap, but you're talking about a 10-year window where you're not going to have meaningful nuclear additions. Natural gas can fill that void, and even post, when we have that nuclear running potentially, you're still going to need gas.
Yeah.
If you're a China or an India, today you're importing from Qatar. It's a relatively long route, or you're importing from the U.S. It's not clear that the U.S. is always going to be there to export to you. So Canada can play a role in diversifying the supply chain for Asia.
Yeah.
And geographically, we happen to be well situated.
I want to bring it back more into current times. And we have some horrible fires that are taking place, actually right across the country, but specifically we're seeing a lot in Alberta, Saskatchewan, Manitoba. And we're seeing a shutdown of a lot of production, oil production. Is that material to the oil market?
So, horrible situation.
Yeah.
Right now, there's about 300 to 400,000 barrels a day of oil shut in. That's largely, I believe, Cenovus, MEG, and the Christina Lake project, I believe. Those are not trivial volumes, right? Yeah. So the market, maybe to contrast, the market was quite concerned about the incremental barrels that OPEC was adding to the market.
Right.
They added 414,000 barrels a day, just for some perspective, in May, June, and July. If we lose this 400,000 barrels a day for a period of time, that offsets that. The quality of the oil is also very important.
Right.
So Canada produces a medium heavy barrel. A lot of the production growth that we've seen globally of late, which has come out of the US shale, has been a light sweet barrel. You need those medium barrels to mix with the light barrels to put into the refinery to make the gasoline and diesel that we consume. Before I came down, actually, it looks like there's some rain in the forecast, which is going to provide some reprieve and might lend to some production returning to market. Hopefully that production doesn't stay offline for a meaningful amount of time, but barrels lost are barrels lost. Yeah.
What is your short-term look on oil right now, let's just say in the next, 3 months, 6 months, given OPEC and what's happening elsewhere?
So it's been hard, and we've talked before about kind of this disconnect in sort of supply-demand fundamentals, inventories, and price.
Yeah.
For the better part, I would say, Kim, for the last 16 months, the market has been anticipating, consensus has been anticipating these meaningful builds in inventories, and that's got the market, despite the robust near-term fundamentals, has got the market relatively bearish. We haven't seen those builds. If we look at the first half of this year, inventories have built, but not meaningfully more than normal, and definitely not as much as the market expected. On paper, when we look at balances through the end of the year, we're supposed to see sizable builds by the end of the year. In the fourth quarter, we might see 2 million barrels a day of builds, which would be meaningful. My caveat is that we've been expecting these builds for a very long time, and they haven't materialized.
And if the build's not materialized because of the supply has been lower, the demand, which side?
So a couple of weeks ago, the IEA came out, not to get too technical, but in the oil balance, you have your supply, your demand, and that should equal the change in inventory.
Right.
There's a line item on the balance that's called miscellaneous to balance, which is the plug.
Always bad things come from miscellaneous to balance everywhere.
So they came back out, 2 weeks ago they came out and they said, by the way, demand in 2022, 2023, 2024 was higher than we thought, so they put it into demand. I think we have to be very mindful that we're talking about a market, Kim, that's 105 million barrels a day. And when we talk about the margin, right, the surplus or the deficit, we're talking about 500,000 barrels a day, 1 million barrels a day. So we're applying a lot of precision, but in reality, it's a 105 million barrel per day market, and we don't have complete transparency on inventories globally.
Right.
Today at $65 a barrel, I'm less bullish than I was 2 weeks ago in the 50s. I think on paper, there is more upside risk in the near term because of geopolitics and the potential supply disruptions that stem from that. But I'm definitely concerned that growth slows and what that means ultimately for balances later this year. I'm not in the $40, $50 camp, but I'm also not in the $80, $90 camp unless we have some sort of supply-related disruption.
What are you watching when when you're watching, when you talk about, there's a lot of things to pull on there. So from a geopolitical standpoint, what's going to move markets? And then also from a demand standpoint, because as we all kind of just wait and see what does trade look like really when deals happen, don't happen, whatever, everything. We're all tired of it. But.
So on geopolitics, I would say that 2 months ago, consensus was very much, hey, Trump is going to forge a deal between Russia, Ukraine, and there's going to be something positive that happens with Iran in the Middle East. Both of those things look far less likely today.
Ukraine's special forces has a lot to do with what happened lately.
And Iran has been very clear that the red line for them is that we're going to continue to enrich.
Yeah.
The red line for the U.S. is that no, you're not. So I'm not sure how that plays out, and I imagine there's some political gamesmanship taking place, but the likelihood that Iranian barrels are going to return en masse to the market, as some people are expecting, I think is lower probability than maybe what some folks thought a couple months ago. So there's a lot of production at risk. We haven't talked about Libya, which is also having issues right now, in addition to the challenges in Canada with the wildfires. A lot of supply at risk and very tight balances. Now, I don't know how bearish I can get on this idea that, hey, demand is going to fall apart later this year and I'm going to get phenomenal supply growth. The weakness in price that we've seen over the course of the last several weeks has already led to a reduction in the number of rigs drilling for oil in the Permian Basin. If you look at frac crews, the number of folks that are out there working, that number has fallen off meaningfully as well. So I think we have to remember that the market has, I think, a tendency of maybe being more bearish on demand than we should be. And we definitely are, at least over the course of the last 10 years, have been far more optimistic on the supply outlook than what's been realized. So I kind of keep that in the back of my mind when I'm looking at the market. The here and now, crude is backwardated, right? So refiners are paying a premium. I'm paying $1 premium to have crude in July versus waiting till August.
Right.
That's meaningful. And refinery margins, right? What the refiner gets paid to refine that crude that they're paying premium for today are sitting at 14, 15-month highs. So there's no indication on the refinery side that there is this capitulation in demand that we're worried about. That's what we're looking at today.
Fascinating. Give me 20 seconds on gold.
Oh, well, we like gold. You just switched there. We like gold. We've liked gold for the better part of the last 2 years, largely on the heels of central bank buying. Central banks in the emerging market continue to buy gold to diversify away from the fiat, which makes up the bulk of their reserves. We did see weakness in gold over the course of the last couple of weeks because equity performance was strong. So you saw retail moving out of gold into equities, and you saw that in the ETF open interest. It came down. Ultimately, I think gold needs to be part of your portfolio, serves a very different purpose than the bulk of the stuff that you already own. And I'd like to be on the side of the central banks that have far deeper pockets and continue to buy gold.